This episode looks at Japan and Latin America trade, the ADB's new suggestion to governments amid higher for longer oil prices, US 10-year Treasury yields at new highs, and Germany's new attempt at growth. Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, the founding CEO of Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundgren's Investor Insights. Join us as we analyze developments in major economies and financial markets globally.
Hello, Mel. How are you doing today? And of course, also hello and welcome to our many listeners. How's life?
Yes, Peter. We actually coming off from a webinar. It's the start of our quarterly webinar for our China fund. So we have been very upbeat about the Chinese economy and Chinese assets. So we're gonna make it a regular thing where we discuss what's the latest, what's the newest feature of Chinese assets, and we did that yesterday. Thankful to our participants for tuning in, and maybe this is an opportunity for me to invite the listeners to our next one, which would be in the 11th of August. So very interesting findings about how fast Chinese residents are adopting AI solutions. It's very active in China right now. So yeah, really good discussion. How about you, Peter?
Yeah, but let's take off there. I watched the webinar yesterday, and thank you for taking the initiative to organize it. And it's interesting, and of course, we should mention that it is our China fund that is hosting the webinar, but it is not a product sales sort of session. It is actually to share, of course, with the investors what's going on in the fund, how are we at our Lundgrens thinking about China together with our cooperation partner. For people with China interest, it's a good webinar because it is taking up some themes that we're looking at in our fund and how we manage the fund. So that was good. Thank you, Mel. Busy here as well. Different things, but also busy in our defense fund. And yesterday, actually, two articles about our defense fund. One on the Danish Newswire and one in the leading newspapers in Denmark. But it's sort of a particular asset management coverage is there. And they were reporting about our new investments in the defense fund and also the new direction or an additional direction that the defense fund is trying to take. And as we are growing, they very kindly also mentioned that our fund is now open for new investors, as we have room for expansion now again. So a lot of things going on, and a lot of people are getting invited here to everything. So, so
Very
it's
exciting.
yeah, investors do not need to go anywhere else. Just stay tuned in here. The world also offers a lot of happenings, and is why we're here, like usual, to dive into a couple of themes that we pinpoint are worth to observe, spend time on.
I can start, Peter, with Asia. Of course, that's where we are right now. Actually, a lot of interface between major economies here. World leaders, at least, are flying into Asia. Even our own Southeast Asian leaders are in Cebu in the Philippines right now for
Oh,
ASEAN Summit. So there is an upcoming visit between Trump and Xi Jinping happening in Beijing next week, so something to watch out
yeah.
for. While its neighbor Japan is actually pursuing a separate trade deal with Mercosur, so that's the Southern Common Market for the South America. So that one is a bit more certain. I wanted to talk about really the Trump and Xi meeting coming up on May 14th, but details are scarce right now. I think the White House is really paying attention on the US-Iran conflict at the moment, so not a lot of development there. But
Mm.
now we can talk about Japan and Latin America. It seems that Japan is following the footsteps of its neighbors, namely China, in opening up wider trade routes towards Brazil, Argentina, and Bolivia, the Paraguay and Uruguay. So they are trying to open up a larger trade agreement with this region. The direction is really to diversify trade away from a heavy reliance on the US. It is a hard lesson that the world learned after Trump's tariff war in 2025. So now the response is really to find other friends, and they are doing that. Um, Japan is not as exposed to Southern America as its neighbors are. Currently, it only has agreements with Chile, Peru, and Mexico. So there is a lot of room to grow, a lot of space to expand. The US remains to be the biggest export destination for Japanese goods, followed by China and Taiwan. So it's very Asia centric as well, which makes sense because, of course, they're neighbors. It's easy to ship goods towards there.
Mm.
But when we look at the numbers in 2025, South America only accounts for 1% of Japanese exports. So that
Mm.
is really a huge untapped market for Japan and Japanese manufacturers. Of course, there is competition because China got to the Latin America deal much, much earlier. But of
Mm.
course, there's still room to pursue that, especially where in like economies like Brazil, where there is a growing consumption base, a pretty robust activity relative to aging Japan. Of course, that's favorable. So that's a space that we want to see develop. They have had, I think, two exploratory initial kind of talks with trade leaders. So they're looking to move that forward with a more formal signed agreement. And we're looking forward to that.
Yeah, this is an interesting move. Japan is basically well known as a fantastic export nation, but still there is a very
Right.
close society. They're simply not the fastest mover when it comes to connect with other countries. But this simply underlines the very interesting and pretty fast moving trend that is going on between the different Asian countries and Latin America. It's absolutely fascinating how fast these trading routes and maybe also for capital moves, routings are
Right.
established and will develop. I know, of course, there have been between Europe and Latin America also some, that's basically the same trade agreement. It shows how the world is moving away from US, but it is also showing another very long-term trend. A lot of trade agreements over time and also free trade zones are getting established around the Pacific Ocean.
Mm-hmm.
And it is simply showing how powerful the cross-Pacific Ocean trade and investment flows will be in the future. That, of course, also partially include US, no doubt. But it is moving a world that was very North Atlantic focused with extreme dominant countries, also in global politics and economy,
Yes.
based around the Atlantic, in particular North Atlantic, as of US and Europe, sort of fading a bit out, the strengths, but around the Pacific Ocean, it is strengthening a lot. And it's where sort of you'll see a very different economic centrum in the future, so to say. So it is moving from one giant ocean to another ocean area, and that is
Yeah.
interesting. And it's going very fast, faster than people believe, as usual. Good, but this is interesting. It's highly interesting, Mel, I agree. But there's more stuff from actually from just around the corner, where almost where you live, because the
Right.
Asian Development Bank is based in Manila, and
Yes, it's about
actually,
maybe 20
yeah.
minutes from our office here in Manila. But they did release a very interesting report. I think it was a week ago, a few days ago, where interestingly, the ADB kind of admitted that the initial forecast or estimates that they had about how long and how bad the oil price conflict will affect everyone, affect the region,
Yeah.
it's kind of worse than what they initially predicted. Um, and they're now saying that the outlook is showing that oil prices will likely stay higher for longer. And this required a recasting of their growth and inflation forecasts for the whole Asia Pacific. And one key feature in that report is that they were telling economies in the region to actually wind down blanket fuel subsidies and tax cuts on fuel.
Yeah.
It kind of sounds contradictory, but the reason is that they're suggesting to for governments to move towards targeted aid. Granted that it would be a much longer problem than they initially anticipated.
Mm.
They said governments cannot sustain
Yeah.
providing this much uh, subsidy or
Mm.
tax cuts are essentially foregone government revenue. So there
Yeah.
is a shrinking fiscal space for them to continue providing this relief. So
Mm.
they should move towards targeted aid. So they should still help, but only those that they know for sure are really in dire situations because of the oil crisis. So maybe that's instead of providing subsidies at the pump, just restrict that benefit to say public utility drivers and operators, or maybe bus operators across provinces or regions. Yeah, so the key here is that the government still need to keep some buffers.
Mm.
We know that this is a quite crazy day and age where one guy's pronouncements can change the entire economic landscape globally. That's one risk that remains true. And then we've
Mm.
also been reading about like extreme climate changes, like El Nino phenomenon is like being
Yeah.
discussed recently.
Mm.
So that could be another shock. And governments need to be prepared for any such shock. And you can't spend everything that you have in this one instance. And at a practical perspective, it's only May. You still have like 7 months left for the year. So you can't burn through your annual budget trying to address this conflict. It is not watering down or like simplifying the extent of this effect on people's lives and people's pockets, but there really needs to be some adjustment. And they actually presented new scenarios. So they were trying to project it like if it resolves in a month, it's not too disruptive for growth. But if it extends to like 3 6 months, it would be worse. Now their base scenario is that prices are already peaked in April, but it would be slow to come back to the pre-crisis levels in February under $70 a barrel. And their
Yeah.
severe scenario is that prices will stay above $100 a barrel until next year. So
Yeah.
that is quite a wide range, extremes, if you will. And that would bring down developing Asia growth from an initial 5.1% estimate for the year to 4.7%. So that is quite a downgrade. For Southeast Asia, developing Southeast Asia, so that's the Philippines, Thailand, Malaysia,
Mm.
Vietnam. It's 4.2% from 4.7% projection initially. So again,
Mm.
it's a very, very large impact. So
Mm.
yeah, clearly it won't be sustainable for governments to continue providing very, very generous subsidies in a higher for longer scenario. And we see the point there, Peter.
Absolutely. We can say, first of all, luckily, the oil is trading below $100 per barrel again today, on the back of how the negotiations are going between the US and Iran. As we basically agree with what Asian Development Bank is saying, the key is the best situation or solution is the private sector and households to be so strong economically that they also can withstand whatever sort of these kind of crises that will occur from time to time. And this is This is correct. We say, okay, if there are very specific areas or segments where people are really hurt and it's about to crash, it of course makes sense to say, okay, is it worth to have a look and say, okay, how could an economic aid look like? The general approach that the government should rescue everybody and everything every time there is a price swing, it of course doesn't work. It is contradictory, and the governments they should stay fiscal strong. Yeah, the government should focus on making the private sector and the private households so strong economically that aid is not needed. That is actually the correct way of approaching the economy policy. So we strongly agree there, and this view also counts for the old economies in the West. This is not just a discussion in Southeast Asia. This is also a big thing in the old economies, where people, as we see it, in principle, are more stretched and more stressed than in emerging markets in many places under the current high energy prices. And that is, of course, interesting, and again, showing how the world is changing. Yeah, so we'll see if there are any politicians listening to our podcast. It might be, we never know. But for sure, but it is extremely important.
We actually want to ask our listeners at this point, when do you think will oil prices return to its pre-conflict levels of below $70 a barrel? Feel free to use the poll feature of the app that you're using, and we await your answers.
But as we are waiting, and you mentioned next week will be fantastic, interesting, yeah, when the two mighty presidents of the world they meet, yeah, and
Yes.
as a basically what we're discussing today, also the oil price, the conflict in Iran, or the reason for the high oil price is of course a top theme in 1 week when these two gentlemen they shake hands. But
Yes.
so I need to tell you just sort of one of these pieces of information that has simply it might be interesting and it has no use, but anyway, if you consider that the Chinese president at any time, as it is now currently President Xi, is not really visiting so many countries, not doing international visits in that sense. But when he as when he goes abroad for a longer time. Yeah? You would say, okay, he considers himself as the mightiest of them all, and everybody should come
To
to the
Beijing.
to the president for China, that is the kingdom in the middle. Yeah,
Yes.
um, but there is a small practical issue actually. Because China is, after all, it's basically a communist country. Yeah, it's a mighty seat to have the presidential chair. He has two jumbos, two Boeing 747s, so two jumbo jets, like the US president has. But the thing is, when the Chinese president is not using his jumbos for traveling, they go back in the fleet at Air China because it is the national
Oh,
carrier. They actually have these two jumbos, and they are normal in include in normal passenger traffic when President Xi is not traveling. But you could imagine how much it takes to simply reconfigure these two planes when Xi is going.
right.
We know the two numbers of these airplanes. As each airplane has an ID, and we actually know these two IDs. But we never fly Air China. But if we did, we could actually study and see if we are flying with the same airplane.
You're flying on a presidential plane.
But they need to be reconfigured, and it takes ages, and it also needs to go through all kind of security check
Yeah.
and mechanical check. It takes months to prepare the planes if you want to go. So that is the
The
that,
logistical
that is
nightmare.
that is sort of preparing. Okay, I want to go overseas. Yeah, he needs to call his somebody and say, okay, you can go in 3 months. Yeah. So that is actually an interesting story about the Chinese president's fleet. He has two jumbos, but he shares them with the normal man on the ground.
Yeah.
Good. Anyway, let's fly from China and Asia to stay on the focus on the squeeze right now that the oil price is generating around the world somehow or the other. We can discuss the US 10-year Treasury yield. It is the mightiest interest rates of all interest rates in the world, the 10-year US government bond. It is almost now trading at a 10-year high.
Yes.
And is it discussed? Yes, of course. It's as mentioned, it's the mightiest interest rate in the world. So of course, it's something that we look at every day. Everybody in the financial market look at it every day, but it is not something that is really in the headlines. This is something that's is actually when some people like to talk about the perfect storm and everything. But if we should talk about a crisis coming up or more concern about the world, then this is actually sort of a move because it's way too quiet. It happens. I know if we go back to 23, we were autumn 23, we were a bit higher than now actually, but um, but we are trading at 435 again, and this is high. And we should ask ourselves, why is it climbing upwards all the time? One explanation is fair enough to say, okay, there's pressure on oil right now, so there's pressure on inflation, and that reflects that interest rates are going higher. Yes, but will the central banks hike rates on back on the higher oil price? And this discussion we've touched a bit now and
Mhm.
then, and we continue to say no, because the oil price will drop down again, and it will actually just fuel the crisis if central banks, including the
They
ECB, starts to hike rates just because of a high inflation that is
agree.
caused by a higher oil price. If
Yes.
it's a sort of following through inflation, it starts to be more difficult. Still, the 10-year rate in US is going up. We are concerned about a concern in the market about the credit quality, credit risk, credit crisis, and this is basically what we have been arguing for some long time. Towards the midterm elections, the US president will try and be needed to spend more money, try to squeeze more money out of the fiscal budget to help them simply win back voters. Yeah,
Yeah.
that's it. And this will hurt the comfort about the US government budget even
Yes.
more and could send rates even higher. And one thing is for sure, the interest rates going higher, and as mentioned, almost at a 10-year high. This is not due to growth. It is not due to too much GDP growth. That is the one thing we can say for certain. And that's actually a bit sad because that would have been okay as a higher GDP growth and high interest rates. That we can live with, and that is a fine situation. But it's not the key, as a GDP goes under pressure, yeah, and interest rates are going upwards. It is a situation that, as mentioned, has been very much under the radar screen. We have touched based on it when we're talking about what we think will happen towards the midterm election. We are afraid that President Trump will try to burn as much money as possible, and that's part of the story we are getting closer to now. We are now entering a sort of a season that we're getting closer to the midterm elections, and we're getting closer to a situation where Trump might need to do something. And
Especially
Biden,
with his popularity ratings going down. Yeah.
exactly. So this will our increased attention, that's for sure.
Right.
And to end up in sort of the my own region, we have again observed the German government trying to come up with as a maybe a 2035 plan. There are some discussion, and we can disclose it is absolute. It has nothing to do with a plan. If it is a plan, we don't know. But what we notice is, and that a catastrophe. I have not seen a single line in any newspaper or any sort of news agency outside Germany mentioning what's going on with the economic planning in Germany. And it is the biggest economy in Europe, and it has simply lost interest completely what is going on in Germany. It is a catastrophe for Europe, we can only repeat. And today, next sort of welcome internally in Germany, that was one of the leading economic institutes. They cut the GDP growth forecast this year from 0.9 to 0.4. And our best guess is that it will be lower than 0.4. And it is back on 3 years no growth, zero growth. And then we have a sort of oil price turbulence, and the
Yes.
German economy is simply not strong enough to absorb just these movements. We of course have an eye on it, and we also look into some of the suggestions that is coming from the government, and it is far away from true solutions. And we can also repeat the true solution includes more work, higher working weeks, more work, longer working weeks. But that's another story. It's a no-go in Germany. Another year with a fourth year probably will still stand in the German economy. Should that worry investors? For sure, it should. Yeah, unfortunately, it's not a positive news. If news are bad, they are bad, and we need, of course, to
Discuss as it is. Yeah.
yeah, and take it into account. So anyway, Mel, these ups and downs, are we? How much sunshine do we see in the world? Is it? Are we under pressure?
Well, we are still seeing more clouds in the horizon, Peter, of course, as more and more people feel the pinch from the oil supply crisis. There is greater nervousness in the markets, but still, we see that some economies are well positioned more than the rest. And by that, we see developing and high growth economies in Asia relatively better than the rest of the world, particularly the old economies, in terms of holding up against this high oil price scenario. We still see opportunities ahead, especially in Southeast Asia and China. There is ability to continue growing, and of course, that bodes well for investments in this region.
Overall, we remain as upbeat in a way, sort of globally. We reckon that the higher oil price will cost a bit in GDP growth. We favor the countries with they have some agility, as that is actually in particular, yeah, emerging market countries. On the fixed income side, we have for some time discussed, and also here in the end of our podcasts every time, how to deal with the interest as simply interest rates going up like the 10-year US bill. And that is only to say, okay, we prefer a shorter duration, so we will be below benchmark in duration, but we're actually okay with credit risk. So it means that we just don't try to avoid the longer maturities, but are happy to keep, let's say, investments in emerging market bond markets as well. So this is basically, you could call an adjustment. So otherwise, we are okay, and we are okay happy.
Yes.
So thank you, Mel, for sharing your insight. It's great as always. And most thank you to all the listeners, of course. We're so happy that people tune in. And that actually means that we will come again next week.
Thank you to everyone.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Longines Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts. Longines Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more.